Who's
Yes.
left to do the job of price discovery? Does the market lose its ability to correctly price stocks?
Passive is like they are just riding on the train. The driver is leading the bus or the train.
Welcome to the Index Investor, a value research series where we dig into the world of passive investing. Today, we have with us Sahil Agarwal. He's director at DR Brokers. Sahil, great to have you on the show.
Thank you. Thank you so much, Richard. Thank you for having me.
Now, today's conversation is around a question that's getting louder as index funds grow in popularity, both in India and globally. And that question is passive investing getting too big? Let's get into it. So, passive investing has been on a remarkable growth trajectory in India. We've seen index fund AUMs rise sharply over the last few years, and globally, passive already rivals or exceeds active in many markets. So, Sahil, as passive investing grows, is there a point where it could become too large for markets to function efficiently? Is there a tipping point?
Ruchira, I would say, let's take an example of the US market. In US, 55% of the market penetration is into passive funds.
Right.
45% is into active. Whereas in India, only 18% is into passive investing and 82% is still active. So I'll take a 10-year scenario.
Mm-hmm.
2015, US was at around $3 trillion in passive. Today, it has reached $20 trillion. So it is 6x.
Yeah.
2015, 1.5% in India, 1.5% into passive, 98.5 into active. And today, in just 10 years, we have reached 18% into passive and remaining 82 into active. So we are at 12x. So I think that if in US, we haven't seen any problem, any challenges, any concern, I do not see any challenges coming forward nearby or anywhere in the future. Active and passive, they both coexist.
Mm-hmm.
There has to be a balanced portfolio. It does not signify at all that passive will overtake active investment. If ever it takes, the price difference or the price will fluctuate. When price will fluctuate, the active investors will come forward and will grab the opportunity. So it's a balanced approach. I don't see it as a negative thing. I see that instead of discussing the future challenges, which US hasn't seen, which is 3 times above us, 3 times beyond us, after us. So I think we should see the current opportunity.
Right.
And global players, Vanguard, BlackRock, they are mostly into passive. And their assets under management has crossed active funds. Still, the impact is positive in every way. And we are pretty sure that in coming years in India also, the ratio from 18% will also increase.
Okay.
Yeah.
So, like you mentioned that in US, the index funds, they're over 50%, over 50% investments in index funds, and whereas in India, it's barely 20%. What does the global data show? In markets where passive adoption is much higher than in India, like the US, have these concerns played out in practice or have markets adapted? Can you elaborate on that bit, please?
Sure, certainly. See, in US, there are around 2,700 to 3,000 index funds.
Mm-hmm.
In India, only 670 to 700 index funds. So we are far, far behind. Oh. And in US, there are only 3 major global players, that is Vanguard, Street Advisors, and BlackRock. These are the top passive mutual fund AMCs or advisors which manages the portfolio, and we are still lag behind. So I do not see that I see there is a huge opportunity ahead of us, which we can grab, investors can grab, and they should grab.
When it comes to active investing, active fund managers, they research companies, they form views on valuations, trade on that information, and that is what keeps the prices honest.
Yes.
Whereas passive funds, they don't do any of that. They simply track the index. So If passive starts to when and if it starts to dominate, who's
Yes.
left to do the job of price discovery? Does the
Great.
market lose its ability to correct price, to correctly price stocks?
Great. I have heard this question lot many times, and it's an excellent question. I would answer this that yes, to somehow I agree with your point that active investors, they do the market research. Passive is like they are just riding on the train. The driver is leading the bus
Yeah.
or the train. So similar is the case. Active investor, they do a lot of research. They do profit earning ratio studies. They do earning. They meet the top management. So yes, price and active pricing is done by them. However, the passive index, they keep a lot of money into inflow to balance the market or to maintain the price. We need to have passive investments, but the price is more or less decided by the active traders.
Now, let's talk about another structural concern, which is concentration. So, most index funds, they are market cap weight. So, the bigger a company's market cap is, the more money flows into it automatically.
Correct.
Critics say that this creates a self-enforcing loop. Large stocks keep getting larger inflows regardless of fundamentals. So, is that a valid concern? Does the market cap weighing in passive funds create an unhealthy concentration in large stocks?
See, few years ago, I would have agreed with your point that mostly the concentration is into large cap. Let's take an example. In flexi cap, 70-80% allocation by most of the fund managers, they are into large cap. But now we have around 700 passive funds in which we have active momentum, Nifty 50/30. There's a whole universe out there where you can allocate your funds as per your goals. You need to decide what exposure, what long-term horizon you have, what is the risk ability you can take. And there are many funds available which have less large cap exposure and much more small, mid, and sectoral also.
Okay. Now let's come to the behavioral dimension of this debate.
Yes.
It's about how passive flows behave during market extremes. The argument goes that when markets fall, investors redeem passive funds, which forces selling across all index stocks, amplifying the correction, and the reverse during rallies. So, do passive flows actually amplify market rallies and correction, or is this concern overstated?
See, I would agree with your point. Till some extent, it is yes. When there is a short-term huge inflow, they can drive the market. They can, for a short period, yes. But in long run, it is only active investors who decide the price, who decide which sector the participation is more, and they take it forward. So the lead is from the active. So passive for a short period, I agree, but in long run, they are both correlated.
Now, finally, let's bring this home for the individual investor watching us. All of this is a macro level debate, but someone sitting at home and deciding how to invest their savings is naturally wondering, how should I be thinking differently about my passive versus active allocation?
See, I'll share an example with you. Fund A, which was a top performer in 2014-15. There is a high probability we have seen in the past that the best fund, which was 10 years ago, might not be the best fund today. So you need to rebalance the portfolio. Passive and active both should be held in the portfolio. So I'll just share my screen if you will allow.
Sure.
This is a typical example. In 2014, the fund A, which was the top performing, in 2025, it became the 270th. It has reached 270th rank. Fund B, which was second in 2014, 2025 tak, it reached 208th. So we need to see that if fund manager also sometimes makes mistakes, they select the wrong stock. It is not that fund manager is always right. So if you want a universe, sometimes I heard people saying, yeah, market upar chala gaya, mera to fund chada nahi. So if you want that kind of thing, you can only invest in index. We can relate this example with my favorite is Hanuman ji example. जब उनको संजीवनी बूटी लाने भेजा तो जब वो पहाड़ पे पहुंचे he wasn't aware which is the संजीवनी बूटी. So he took the entire mountain. If you want the entire mountain, you should invest in passive. But if you think you can track market very closely, active shifting is required, and then I think active is there. But for a balanced portfolio, you should have both the active and passive in your portfolio.
Well, Sahil, thank you so much for joining us on the Index Investor. You've helped us see both the strengths of passive investing and the legitimate questions worth keeping in mind as it grows. Thank you so much.
Thank you so much. Thank you, Ruchira. Thank you for having me.